Hello, Uncle Jim here. Today I want to share with you how I sell put options. I do it in a safe way and I'm able to make some really good income monthly off it. So stay tuned. I think you're really going to enjoy what I have for you. Now, before I jump into the key points of this video, I do want to give everyone a market update. Today, the CPI numbers were a lot better than people thought. It was showing inflation actually has come down, and I think this is a really good thing for the Fed. My guess is they may not increase the rate so much going forward, and they may even turn around and start lowering them if we go into a fairly deep recession. So it's been a really good thing for the market this morning. It's way up. Makes it kind of odd to be doing um, a video on put options, especially since you really don't want to be selling put options when the market's up so much. Like today is not a good day for selling put options. I am going to share with you a trade I did yesterday. The market was down a couple hundred points yesterday, and I was able to do a nice trade, and I'll share that at the end of the video. So, one of the first things I want to talk about is when you're selling put options, I do it in such a way that I strictly want to own those companies. I only do it with companies that are value companies, typically that pay good dividends. There are some exceptions. I do like Google, I do like Apple, which don't pay really good dividends, but they are really good companies, and they probably will start paying bigger dividends at some point down the road. But it's made it a lot easier, especially if you get, you know, the market goes down even more and some stocks get assigned to you. It makes it a little bit easier to kind of stomach that assignment. And I've had that happen several times, and a lot of those positions are already um, above what I paid for them, which is really good. One for instance is Micron. It's already above what I had what it was assigned to me at. So again, pick good companies, good ETFs too that pay good dividends. Like another good ETF is SCHD, which is a growth-based ETF, and it pays a fairly good dividend. So stick to those value companies. I like to call them the kings, investment kings, mainly because again it's companies you want to own. You want to own the rest of your life. A lot of what I invest in I plan to keep the rest of my life, live off the dividends, and pass the rest to my son. So I also, when I'm selling puts, I like to try to get a 10% discount from wherever it currently is. So to give you for instance, if a stock is trading at 50, if I can get 10% off, I feel like I'm doing pretty well. Like so, 45 would be fairly good. And then I also look at the delta. I do a lower delta for my puts than I do my calls. I typically do a 15 delta. So if I can get a 10% discount and it's around that 15 delta, then that's really good. I might even go a little lower if I need to, because again, I like to stick to that 15 delta. Most of the trades I've done since I've done the 15 delta have remained outside the money, whereas when I was doing the 20 delta for the puts, and I'd still do 20 delta for the calls, some of those ended up in the money and ended up being assigned to me. But again, like I mentioned earlier, it's worked out fairly well for me because most of those, or not most of them, a good number of them are above what they were assigned to me at. So, and then I always start with cash secured puts. I don't ever do naked. It's too risky. I don't like to leverage things, and I typically start with a cash secured put. So, and then if I'm able to find a put option to purchase, then I will. Let's kind of go through a quick example. So, say you're looking at a company, let's say Cisco, it's at $50. You're looking to pick it up at 45. Well, I would do a cash secured put for that 45, but then typically I'll go out $10. I try not to go out past $10, so I'll look for a put at 35. Now, if I can buy that fairly inexpensively, and that's the key point, because sometimes you'll find people will, they'll buy a lot of puts at those levels, and then for you to get them or pick them up, you'd have to spend quite a bit. I like to keep it within 5, 10, maybe $20, depending on what stock it is. I like for every contract to try to get $100 for each contract. So if I'm able to pick it up and I'm able to still get $100 for that vertical put credit spread, then I will. So in a sense, I'm starting with a cash secured put, and then I'm turning that into a vertical put credit spread, but I still have enough cash, and I want to emphasize this, to cover that assignment. So I don't ever do naked, and I try not to ever use leverage. I always have enough cash, not just to cover my puts and my vertical put credit spreads. I have enough cash. It's kind of my emergency fund. I've got enough cash to live on for at least 6 months. And during the biggest part of the bear market, I actually had enough for a full year. Now, another point I'd like to make is when you sell these cash secured puts or the vertical put credit spreads and you are assigned, because the market can drop drastically and suddenly you're in the money. And in the past, it's been pretty rare for assignments before the expiration. Maybe a week before the expiration, an assignment would happen. Now, during the bear market, I noticed that changed quite a bit. And I actually spent time talking to Schwab, and that the reason it changed was a lot of people were having margin calls. So I did have some that got called maybe a month. I think I had one or two that got called 2 months before they were expiring. And most of that had to do, again, with margin calls that other people had. And they needed the cash, so they had to put the stocks to me so they could get that cash in order to deal with their margin calls. So, and then I also wanted to mention when those happen, it kind of forces you to do the wheel. So, you sell the put, you pick up some cash, then it gets assigned to you. And in almost every instance, on the ones that have been assigned to me that are definitely currently above what I paid, then I'll sell a covered call. And that's the wheel. The wheel is literally, selling a put, getting assigned, selling a call, getting assigned, and doing that and doing it more and more. And it kind of goes around like a wheel. So in a way, it works out fairly well. So I don't worry too much about assignment unless it's a stock that I don't want to own anymore. And the only instance of that is maybe ARKK. I did trade with ARKK or ARK from Kathy Woods earlier in the year, earlier this year and the end of last year, and I did pretty well with it for a while. But then it's been hit really hard. I think it may be below, maybe around $30 or $35. I still own some of it, and I still write covered calls, but I'm not doing any more puts related to it. So, and then I'm going to next share with you one of my vertical put credit spreads that I did yesterday because the market was down. So let's jump into that next part of the video, and I'll share with you how I set up my trade and along the way some of the thought process that went into it. So stay tuned for this next part. Okay, I took some snapshots of my trade yesterday and I'm going to go over them here. But before I do, I just want to mention if you're interested in learning more about my memberships, I've got 2 Patreon memberships. Details are below. I won't go into details about them now, but if you're curious, take a look. It might be worth your while. And also, please subscribe and hit the like button. I'm growing and I would truly appreciate it. So, first off, I've been looking at HP for a long time. It's been on my watch list for over a year now, and it was down quite a bit yesterday. And I found some good premium. I haven't always found good premium with HP, but you can see it was down almost 40 cents at 28.44. So as I mentioned earlier in the video, I tried to get it for at least 10% below. So 10% would be around 25. But you can see here, I actually found it at 24. Now I did go a little higher with the delta. You can see it's right underlined in red here. I did a 17 delta, but my choices were either a 22 delta or a 12 delta. So, and I wanted to pick up enough premium to make it worth its while. So that's why I chose 24, and it also fit the 20. The 10% rule. It's more like 15% below the current price. So I'd be very happy with 24. HP has good numbers. It's good financials, fairly good earnings, and it's also got a fairly good dividend that it's been increasing recently. And I believe at 24 it would be over 4%. So it's a good company. It's a good value company. It's a good company I want to own long term, and it pays a nice dividend, so it'll help with meeting my dividend goals, which I had mentioned in previous videos. I'm trying before the end of the year, early next year, to get to 2,000 in dividends on a monthly basis, and I'm at like 1,800, so I'm fairly close to that goal. Picking up a few of these might, get me over that hurdle. So this is the chain. It's January 20th, 23. I looked at some of the expirations a little closer and just wasn't enough premium. I like to pick up enough premium where I can get it at a price I want. So I'll go a little bit farther out. It does mean I can't do as many trades, but like I had mentioned before, I typically try to make 700 a week, and I've already made over 700 this week. So at this point, I might not do any more trading this week. Now, last week I did a lot less. I think I did like 300. So I may continue to do some more trading, especially with the market up so much. I'm trying to sell some covered calls, but with HP, this worked out quite well. It met all those guidelines. So let's jump into the actual. How do I get over there? There we go. So here's the actual trade, and you can see I picked up. So here's the 24 to sell to open, and I would pick up 56 cents. So I went ahead, like I mentioned. I will typically go out $10 to see if I can pick up some inexpensive puts and turn it into a vertical put credit spread. So instead of requiring 2,400 for the trade, I only need about 900, which is the difference of these two. So for this vertical put credit spread, I only needed $900. Again, 24 times 100, 2,400, and 15 times 100, 1,500. You subtract the 1,500 from the 2,400 and it's 900. And really you should subtract whatever cash you're bringing in. So it's like $800 per contract, or $1,600 for two. So my money will go a lot farther. And again, if this gets assigned, I do have enough cash to pay for it. And I'd be perfectly fine with letting it get assigned and then selling calls on it on the flip side. So and that's typically what I do. When I was looking at the options, I think if we go back, I think I could see 15, and I could see it was pretty inexpensive here. So that's what I'll typically do. So I knew I was looking at 24. Then I'll look, and I could have also done 15 at 12, but I chose the 15 in the actual trade. So that worked out well. And then it was just a matter of submitting it. And again, I typically do market trades. I don't want to be doing this all day. I get on and off, and I don't spend much time. Like today, I probably have spent an hour with some of the cover calls I did, and I think I did 400 or 500 a day. Might be closer to 400 in an hour's worth of time, and I'm able to do that using the market trade. So, and I typically leave it as a day only. And now we can actually go in and look at the status, and you can see here it actually got processed, and I think I did a little bit better. I think it was showing, let's go back, what was it showing? 56 and 8, and it was 59 and 8. Let's increase that a little bit. Yep, 59. So I did a little bit better instead of the 56. Plus, I did better on the ones I bought. I got them for 5 cents. So it worked out well. And for that, so that for each contract was what, $54? Yeah, 59 minus 5. And of course, you've got to subtract any fees. So with two contracts, I made over $100 on this vertical put credit spread. So it worked out quite well. And like I said, I try to do a couple of these every week if I can. To me, it's almost more difficult finding the companies that I want to own and verifying, mainly because recently a lot of the companies have changed their earnings. Like Disney, I think, came out yesterday and they got hammered. I think they were down 10 or 15% because their earnings look pretty rough. So that's it. That's how I do my vertical put credit spreads, and I keep it simple. I try not to take too much risk. I don't do it naked. I always have enough cash to pay for any of my puts that I currently have. And again, I'm okay with it being assigned because they're at values. I'd be happy to own them. I'd be happy to earn that dividend. And, if it's kind of a double whammy. I get the dividend, and, I'm pretty sure HP will go higher than 24. It'll probably, it may never get down there, and that happens a lot too. A lot of my puts end up expiring out of the money, or I close them because they're so profitable. So that's it. I hope you enjoyed it. As always, leave any comments below. I answer all my comments. I enjoy having the discussion, so I encourage you to leave a comment, and I hope you have a wonderful day, and thanks for joining me.